Hello, and welcome to Mayor Brown's webinar on the IRS issues initial guidance on the Qualified Opportunity Zone rules. I am Mark Leeds, a partner in Mayor Brown's New York office and a member of the tax transaction and consulting practice. I advise clients on the tax aspects of capital markets, structured finance, derivatives, financial products, and insurance transactions, and have extensive experience working with both buyers and sellers of complex derivatives. Joining me today as co-presenters are my partner, David Burton, and associate Maria Carolina Greco. David leads Mayor Brown's Renewable Energy Group in New York and advises clients on a wide range of U.S. tax matters, with a particular emphasis on project finance and energy transactions. In addition, David also advises clients on tax matters regarding the formation and structuring of domestic and offshore investment funds. Maria focuses her practice on tax advisory and administrative litigation at the federal, state, and municipal levels. Before we begin, I'd like to mention a few housekeeping announcements. First, as noted under the FAQ widget on the right side of your screen, today's program is being streamed through your computer, so there's no dial-in. For the best audio quality, please make sure your computer speakers or headset are turned on and the volume is up so you can hear the presentation. With that said, let's get started. We're going to begin with an overview and ask, what are these new Qualified Opportunity Zone rules all about? Well, really, in order to fully appreciate what they do, you need to keep your mind on two separate tracks. The first track is the deferred capital gain that generated the capital to put work in the Opportunity Zone. The second track is the income gain, loss, and deduction from the Opportunity Zone investment. Eligible taxpayers can defer capital gains recognized from virtually any investment by investing an amount equal to the gain into a Qualified Opportunity Zone fund. In order to work, the investment doesn't have to be all of the gain. It can be a part of the gain that's recognized during the year, and there's no earmarking requirement either. So a taxpayer will simply take the amount of capital gain that it's recognized during the year, and that creates a pool from which it can make Qualified Opportunity Zone investments. Current income from the investment made in the Qualified Opportunity Zone is not exempt from tax. That income is going to be taxed to the investor as that income is realized. Qualified Opportunity Zone rules focus on both on the deferred gain at inception and secondly on disposition gain from the Opportunity Zone investment. The capital gain that's deferred on the original, that created the original capital to go into the investment has to be recognized no later than the year 2026. In other words, even if the Qualified Opportunity Zone investment is continued after that date, the deferred gain must be recognized in that year. There's really wonderful opportunities to do rollovers as well. In other words, if a Qualified Opportunity Zone investment is disposed of before 2026, a taxpayer can continue to defer the gain by making another Qualified Opportunity Zone investment before that year. And the disposition, gain from the disposition of the Opportunity Zone investment itself can be wholly tax exempt if that investment is held for at least 10 years.
Broadly speaking, the Qualified Opportunity Fund rules operate as follows. An eligible taxpayer invests an amount equal to the gain that he desires to defer in this Qualified Opportunity Fund. The fund may be a partnership or a corporation, as we'll explain better. After that, the fund must make an investment in a Qualified Opportunity Zone property. As will be explained in more detail during our presentation, the Qualified Opportunity Zone property can be of three types: newly issued stock of a corporation, newly issued partnership interest, or tangible property in a Qualified Opportunity Zone. It's important to highlight that the taxpayer cannot invest directly into the Qualified Opportunity Zone. The investment must be made through the fund.
Thank you, Maria and Mark. Now we're going to walk through a simple example to make sure that the audience is appreciating the opportunity and how the numbers work. So in our example, let's posit that you invested invested $2 million in Acme Inc. in 2015, and you sold your stock in Acme Inc. for $3 million in 2018. So you have a $1 million gain. Then you elect to defer that gain by investing it into a qualified opportunity zone fund. So you only have to invest the gain amount. You don't have to invest the full amount of proceeds from the sale of the asset. So you can take that $1 million gain, put it into the fund, and that leaves you with $2 million to use as you like. Next slide. Now, next slide shows the timeline of the two tracks that Mark was referring to. And this is very important to understand to really appreciate the tax benefits. So the first track, the top track, is the tax benefit for the deferred gain. So in our example, if you're an individual, we have a capital gain, the $1 million, so we defer paying the 20% tax of $200,000. Right? So first thing is you don't have to pay that $200,000 tax in 2018. You defer it. Then if you hold your investment in the Opportunity Zone Fund for 5 years, so in our example to 2023, 10% of the tax is forgiven. So 10% of $200,000 is $20,000. So now 10% of the tax is forgiven. If you hold for 2 more years in the Opportunity Zone Fund, so for a total of 7 years, then another 5% of the tax is forgiven, or $10,000 in our example. So now you've had $30,000 of tax forgiven. Then in 2026, and that 2026 is a fixed date that applies regardless of when you made the investment. In 2026, you then have to recognize the remaining tax on the deferred gain. So in our example, $170,000. So just this first tax benefit has been $30,000. So instead of paying $200,000 in capital gains tax, you only paid $170,000, and you got to defer it until 2026. Then the lower line on the slide shows the second benefit, which is the tax benefit for the Opportunity Zone investment. So in 2018, you invested $1 million in a qualified opportunity fund. In 2023, you're then deemed to have a $20,000 basis in that fund. So that amount of tax that was forgiven on the gain, you also get as outside basis in your investment in the fund. Again, in 2025, after 7 years, the $10,000 of forgiven tax, you also get outside basis for. So now you invested $1 million, and you have a $30,000 outside basis in the fund. Then if you hold for at least 10 years, but not beyond 2047, so you have to hold for at least 10 years, in our example 2028, but that's just because in our example we bought in 2018, but it has to be 10 years regardless of what year you bought, and not after 2047. When you sell your Opportunity Zone investment, your basis in the Opportunity Fund is deemed to be stepped up to fair market value, so therefore you have no tax on the sale of your Opportunity Zone Fund investment. So that's a very important tax benefit to keep in mind, that if the Opportunity Zone Fund does well, and you hold it for at least 10 years, you won't pay any tax on that appreciation.
So now moving to the eligible gains and eligible taxpayers. Only capital gains are eligible for deferral through the Qualified Opportunity Fund investments, including gains from both actual and deemed sales or exchanges. This last case, for example, might include disguised sales of property between partnerships and partners. Also, Section 1231 gain and Section 1250 gain are eligible for deferral. However, depreciation recapture is not eligible. The rules are designated in a way that taxpayers can defer gross gains and leave the capital losses. For example, if you have 100 capital gains and $50 of capital losses, the taxpayer would be able to roll over the entire $100 without netting the losses. The proposed regulations take an expansive view on taxpayers that are eligible to defer gains. Individuals, C corporations, including regulated investment companies, REITs, and real estate investment trusts, REITs, partnerships, S corporations, and trust or estates are all eligible taxpayers. Partnerships and other pass-through entities can defer gains by investing in a qualified opportunity zone directly. Also, partnerships can elect to pass through the gains to the individual partners, who may elect to defer the allocable shares.
Notwithstanding the very beneficial rules that Maria Carolina just went through with respect to being able to defer gross capital gains, special rules apply for 1256 contracts and straddles. 1256 contracts are contracts that are accounted for in the mark-to-market method of accounting, but then those mark-to-market gains and losses are treated as 60% long-term and 40% short-term. These types of capital gains do qualify for the benefits of the Qualified Opportunity Zone rules. However, in contrast to the general rule for regular capital gains, holders of 1256 contracts are required to net gains and losses and may only treat the net amount of any gain as eligible for investment in a Qualified Opportunity Zone fund. There are, in addition, special rules for straddles. In general, a straddle transaction is a transaction in which substantially all of the gain or loss on one position is hedged through the holding of another position. So if one position goes up in value and it can be reasonably expected that the other position will go down in value, taxpayer likely has a straddle. In general, the straddle rules themselves for federal income tax purposes only apply with respect to actively traded personal property. But however, for purposes of the Qualified Opportunity Zone rules, a taxpayer can have a straddle even if it's with respect to a position which is not publicly traded property. Furthermore, if any Section 1256 contract is part of an offsetting position transaction with a position that is not a 1256 contract, in other words, someone's using a 1256 contract to hedge an accrual or cash basis position, no Section 1256 net income may be deferred through an investment. In other words, the regulations take a very, very strong position on 1256 contracts. For example, a taxpayer can have a substantial amount of 1256 contracts that don't hedge accrual positions, but if it holds one position, one 1256 contract that hedges an accrual position, it appears that none of the 1256 gains are going to be eligible for investment into a Qualified Opportunity Zone fund.
The fund must be a partnership or a corporation that makes an election to be treated as a qualified opportunity fund. This election must be made as of any month of 2018 or even later. As we pointed out there, proposed regulations are silent, but it looks like S corporations can also qualify as qualified opportunity funds. And there's also a 90% asset requirement that Mark will explain us in detail. But in brief, the fund must have 90% of its assets in eligible property or eligible stock or partnership interest. The fund is tested for compliance in its semi-annual and annual anniversaries, so basically every 6 months. The investment must be in equity for income tax purposes. It can be preferred equity if the fund is a corporation, and if the fund is a partnership, the investment can benefit from special allocations, such as cash flow or liquidation preferences.
Pre-existing entity can qualify to be a Qualified Opportunities Fund. However, there are definitely going to be some disadvantages of using pre-existing entities if that pre-existing entity holds other assets. Because as Maria Carolina briefly described, at least 90% of the assets of the fund have to constitute eligible property investment. Eligible property investment, as we'll explore a little bit further into the presentation, has to be acquired after 2017. So using an existing entity with existing assets in it could be problematic in meeting that 90% requirement. They certainly are at a disadvantage. And the regulations allow a Qualified Opportunity Fund to identify the year in which it becomes a Qualified Opportunity Zone and to choose the first month that within that year that it can be elected to be so treated. That's very important for investors because a contribution made to an entity prior to the time that it designates itself as a Qualified Opportunity Zone fund will not count as a qualified investment. So coordinating the date that the entity elects to be treated as a QOF with the date that contributions are going to be acquired from investors is key to ensuring that you don't have a footfall with respect to the designation. With respect to the 90% qualifying asset test, a qualified opportunity zone must hold at least 90% of its assets in qualified opportunity zone property. And the good news here is that there are three types of investments which will qualify as such: newly issued stock of a corporation, newly issued partnership interests, and tangible business property that's held in a qualified opportunity zone fund. As we're going to explore, it's going to be the very unusual case where a qualified opportunity zone fund makes an election to hold business property directly. In most cases, it's going to be very advantageous to use the two-tier structure. And by two-tier structure, I mean that the top entity will be the qualified opportunity zone fund itself, and then the lower tier entity will either be a corporation or a partnership that holds the qualified opportunity zone investment or business. By using that two-tier structure, as we'll explore in more detail, you'll be able to take advantage of some very, very beneficial rules that allow you to invest slowly over time rather than having to make the investment so quickly. And as Maria Carolina walked us through, we're tested for a qualification at the fund level, not the business level, every 6 months. So if you're looking at a project that's going to have substantial ramp-up time, you can use the two-tier structure to hold a substantial amount of that investment in cash as the investment is going to be made over time.
All right. So now let's talk about what the qualified opportunity zone business requirements are. So as Mark referred to, the qualified opportunity fund can opt for to hold a subsidiary that would be itself a qualified opportunity zone business rather than investing directly in qualified opportunity zone property. So again, you have this choice of the fund buys the property, or the fund buys a partnership interest or a corporate stock. If you go with the business route of owning a corporation or a partnership by the fund, then you do have some additional requirements that apply. So in many ways, as Mark was referring to, it's more lenient and offers far more structuring flexibility, but you do pull in some additional requirements. One of them is that 50% of the corporation or partnership's income must be active gross income. Second one is that they must use a substantial portion of the intangible assets in the active business. So if it has intangible assets like intellectual property, it must use a substantial portion of them in the active business. It can't be a holding company that just holds patents or licenses. There's a 5% limit on financial assets, and there's a no sin business requirement that Mark will get into. The 50% active gross income requirement requires active conduct of a business in a qualified opportunity zone. So we're still waiting for guidance as to what an active business is. And we have questions, for instance, can net leasing qualify as active, and can an active business be conducted by independent contractors rather than by employees? So those are open questions about what is an active business and application at 50% test. Then the corporation or partnership that's owned by the fund that operates this business only has to have 70% of its tangible property in the qualified opportunity zone. So you only have to have 70% of its assets have to be tangible property in the qualified opportunity zone. So that's rather than 90%. So that's a more flexible standard of 70 versus 90. And then a substantial portion of the intangible assets must be used in the active business, as I was referring to before. So it can't be a holding company that just sits on patents and licenses.
There are generous rules for startup businesses, as I alluded to a little bit earlier. In general, the amount of non-qualified financial product, in other words, working capital, that can be held in the business is limited to 5% of the average unadjusted basis of property held in the trade of business. The good news about using unadjusted basis is that as if property is amortized or depreciated for tax purposes, those depreciation deductions or amortization deductions do not limit the amount of cash that can be held. A non-qualified financial property equals stock, debt, partnership interests, all types of financial products. But working capital doesn't count against you. And working capital is generously defined here that it can be held in cash and cash equivalents, that the Qualified Opportunity Zone Fund business has a plan in place that it will put that money to work within 31 months. Most commentators have noted that 31 months appears to be fairly generous. There have been some questions in the context of real estate investments whether or not 31 months is enough. In other words, for some of the larger projects, putting the entire building together within 31 months may be a challenge. But generally speaking, that's a pretty generous opportunity, unintended, to put the money to work over time rather than having to invest it all up at once. And working capital must be expended substantially consistent with the plan that the taxpayer has. In other words, the plan can't simply say that within the next 31 months I'm going to go out and find something, a business, and do it. There's got to be, the plan has got to contain some level of detail, and the actual investment of the cash has to follow that plan. It's not entirely clear how much leniency the IRS is going to give around this point. In other words, suppose that the plan is to build a building on parcel X, and notwithstanding all the best planning, parcel X can't be obtained, and so they go ahead and they build another building on another parcel. Query there as to whether or not holding the money in cash will disqualify the business during that time, because the property that was expected to be built wasn't actually built, and another one was built that was in another space. We really don't know at this point how much leniency the IRS is going to show relative to the plan versus what happens.
So now we have an example to demonstrate the differences between the fund holding the tangible property itself and the fund holding an interest in a corporate or partnership subsidiary that then owns the property. So there's sort of one-tier structure or a two-tier structure. And as you'll see in the example, the two-tier structure provides more flexibility as to what the assets are invested in. So let's walk through the example. So a qualified opportunity fund has $10 million in assets and wants to hold only $6.3 million in qualified opportunity zone business property. It can do this by investing $9 million in a partnership and having the partnership invest $6.3 million, i.e. 70% of its assets. So again, 6.3 is 70% of the $9 million. So then it's going to meet the 90% test, because 90% of its assets are invested in this qualifying partnership, which then has 70% of its assets in qualifying tangible property. The operating partnership then has $2.7 million remaining, and it could do the following with that. It could hold 5% of its total in cash, so 5% of $9 million would be $450,000, and then $2.25 million, so $2.25 million in non-qualifying tangible assets. So, for instance, assets outside of the zone. Then the Qualified Opportunity Fund itself still has $1 million in remaining, and it can do with that what it likes. So it can hold that in cash, bonds, stocks, et cetera. In contrast, the Qualified Opportunity Fund opted to purchase the Qualified Opportunity Zone property itself. So it went out and bought it itself rather than investing in a subsidiary partnership or corporation. It would have to buy $9 million of Qualified Opportunity Zone business property, all of which would have to constitute tangible assets. And then it could hold the remaining $1 million in cash, stocks, bonds, etc. By investing through a subsidiary, it's able to free up $2.7 million to have more flexibility as to how it's used.
As we mentioned earlier, qualified opportunity zone businesses may not operate a SIN business. This slide contains a list of SIN businesses that are enumerated in the cross-reference statute of Section 144. But the question then becomes, if you can't operate any of these businesses directly, could a qualified opportunity zone business lease real estate to one of these businesses? It does not appear that there is a prohibition against leasing property to a SIN business. Only ownership of the SIN business itself is prohibited. As David mentioned a little bit earlier, though, we're still an open question as to whether or not net leasing will be active enough to qualify as a qualified opportunity zone business. But if the property is either not net leased or net leasing itself is okay, the fact that someone else is on the property operating one of these types of businesses doesn't prevent the qualified opportunity zone business from qualifying as such.
So, as pointed out in the beginning of the presentation, the fund can invest directly in a tangible property in a qualified opportunity zone, or opt for the qualified opportunity zone business route that Mark and David just explained. The tangible property can be land, building that is first used by the fund or the qualified opportunity business, building that was previously used but is substantially improved by the fund or by the qualified opportunity business. Also, equipment that was never previously used or equipment that was previously used but, again, substantially improved. The substantial improvement requirement was addressed by the IRS in Revenue Ruling 2018-29, recently released. However, there are still pending issues on the substantial improvement requirements that require clarification. Mark will explore in detail in the next slide. And finally, the tangible property has to be acquired after December 31st, 2017 and used in a business carried out in the qualified opportunity zone for obvious reasons.
For those persons interested in acquiring mostly real estate that's going to be used in a qualified opportunity zone and the building's already built and it's going to be rehabbed as part of the investment, the test as to whether or not so just to back up for a second, if you're going to do a deal with an existing building, the question arises whether or not that existing building was acquired prior to January 1st, 2018. If it's already in existence, then it obviously is. And so it's not only ground up properties that are eligible, it's existing properties that are eligible to be treated as qualified opportunity zone businesses, provided that the taxpayer makes a substantial improvement to that building. The test is extremely generous, but we really don't know entirely how it works yet because there are definitely some open questions. The test that's enumerated in the regulations is that the taxpayer must invest more during any 30-month period than the adjusted basis in the building at the beginning of that period. That 30-month period, there's no requirement that 30-month period be determined as of the beginning of the holding period. In other words, the taxpayer could acquire the property, hold it and depreciate it for a 12-month period, and then at the end of the 12-month period, embark upon a capital expansion program and compare the amount expended during that program to the basis at the end of the first year, which would reflect the first year's worth of depreciation deductions. The test only needs to be met once, and only requirement is that during any 30-month period that the amount expended on the building exceed the amount paid for the building. Really important here, and the point of the revenue ruling that we got was to tell us that in determining whether or not that test is made, whether or not the investment in the building exceeds the adjusted basis at the beginning of the period, we exclude land. So if you buy a building for $10 million and you can establish that $2 million of that investment was attributable to the land underneath the building, well, then all you need to do is make $8,001 worth of improvements to the building over the 30-month period and not $10,001. That's a very, very beneficial rule by being able to exclude the basis attributable to the land. Obviously, cost segregation studies and other transfer pricing studies are going to be really important for a taxpayer to be able to use that it established the amount that it paid for the land. There's no rules relating to how the bonus depreciation rules work in connection with this test. The bonus depreciation rules do not apply to land, but if the taxpayer has acquired tangible personal property such as such as equipment or other types of tangible non-real estate assets, and that property gets depreciated to zero immediately under the bonus depreciation rules, it appears, the way that the rules are written, that even $1 of improvement to that piece of equipment will be sufficient to qualify it to enable it to be treated as substantially improved. Really beneficial rules. The revenue ruling that I mentioned a little bit earlier that was promulgated simultaneously with the release of the regulations talks about the example I just went through, that a qualified opportunity zone buys an existing commercial building for $10 million in 2019, $2 million is attributable to the land, and $8 million is attributable to the structure. And the revenue ruling is very, very explicit that the building will be considered to be substantially improved if at any time the amount that's during any 30-month period, the amount invested in the building exceeds more than the $8 million. In the example in the revenue ruling, however, they tell us that that 30-month period and the capital improvement is satisfied as of by comparing the amount of the improvements to the basis at the inception. I don't think that it's right to read that as an exclusive example. In other words, for this particular taxpayer it was, but for other taxpayers there does not appear to be any requirement to use that beginning of holding period for using the 30-month period. So think about this for a second. You could acquire a building and not really know whether or not you're going to meet the substantial improvement test for literally years into your holding period, because you can use any 30-month period in determining whether or not you met the applicable investment requirement.
Now let's talk about the 180-day rule for deferring gain when you invest in a qualified opportunity fund. So the investment in the fund must be made within 180, which is 6 months, of the sale of the property. The 180-day period begins on the day on which the gain would be recognized if the taxpayer did not elect to defer the recognition of that gain. The proposed regulations list some specific situations illustrating the rule. For example, as you can see in the chart, in regular way trades of stock, the 180 period begins on the trade date. For capital gain dividends received by REITs and REITs shareholders, it begins on the day on which the dividend is paid. In case of undistributed capital gains allocated to shareholders by REITs and REITs, the 180 period begins on the last day of the REITs or REITs taxable year.
So now let's talk about the partnership rules for deferring gain realized by a partnership. The rules and the regulations were relatively lenient and provide a fair amount of flexibility and different options as to how partners and partnerships can use the qualified opportunity zone rules to defer gain. So the first thing that happens is, let's say a partnership sells an asset for a capital gain. If the partnership itself wants to then defer the gain by investing in the qualified opportunity fund, it has 180 days to do so from a date of that sale. If instead the partnership says, no, it's not really our business model to be investing in qualified opportunity funds, we're not going to defer it ourselves, rather we're going to pass the gain through to the partners, then the partners have 180 days from the last day of the partnership's taxable year in which the gain was realized. And that's because that's the day on which the partner would be required to recognize the gain if it was not deferred. So for a calendar year partnership, you'd have 180 days from December 31st of the year in which the gain was realized. So that gives partners some time to make a qualified opportunity zone investment. If instead the partner wants to invest earlier, so let's say it's a small partnership and the partner has visibility to the gain and knows that it was realized. Instead, it can elect to begin its 180-day period on the same date as the partnership's 180-day period. So in other words, if on the date that the gain was realized, on the date of the sale. So if the partner knows there was a capital gain and wants to defer it, the partner can say, okay, I'm not going to wait to the end of the year. I'm going to assume this comes through to me because I'm going to know that it was realized, know that the partnership is not going to make the qualified opportunity zone investment itself, and I'm going to take it and defer it by making my own qualified opportunity zone investment. Section 1256 net income, the 180-day period begins on the last day of the taxpayer's taxable year, even if one or more Section 1256 contracts have been disposed of during the year.
As we mentioned a little bit earlier when we started the presentation, a taxpayer is entitled to step up its investment in the qualified opportunity zone to fair market value if it has held the investment for at least 10 years. So taxpayers who have not met, and it's obviously impossible to do that, to meet the 10-year holding period by the date of the deferral, can continue to hold their investment until the 10-year holding period is achieved, in spite of the qualified opportunity zone funds is technically ceasing to be qualified as one. It's sort of just a technical issue that the IRS addressed in the proposed regulations, telling us that the qualified, even after the deferred gain has been recognized, the holding period continues for purposes of determining whether or not gain or loss is going to be recognized on the qualified opportunity zone investment. And it can be stepped up. You can hold that investment through December 31st, 2047 to continue to recognize any appreciation in the asset through that time. And of course, the gains, which is then held for more than 10 years, will be entitled to be deferred. So even though the deferred gain rules become of diminished importance over time because the deferral period will be correspondingly shortened, it may make sense to continue to look at these even in investments for investments in 2026. In other words, even though you won't be entitled to any substantial deferral for investments made into the late 2020s, or at least through 2026, being able to get the deferral and possible ultimate tax exemption on the qualified opportunity fund investment in and of itself may constitute a sufficient tax benefit to continue to look at these rules through such time. The general rule for the deferred gain is that if the taxpayer disposes of its interest in the qualified opportunity zone prior to 2026, that's the date on which the gain is deferred. So in other words, if a taxpayer in 2018 invests in a qualified opportunity zone fund and the qualified opportunity zone fund disposes of its investment in the qualified opportunity zone property, the property itself, the partnership interest, or the stock, prior to 2026, that's normally an opportunity for the inclusion of the deferred gain. However, the rules provide generous provisions for rollovers. So if the qualified opportunity fund disposes of the property, you have up to 180 days to invest in a new qualified opportunity zone business and continue to defer the original gain. But that doesn't extend the 2026 date. All gain is going to be triggered at the end of the deferral of the 2026 deferral gain. And furthermore, in a generous rule that contrasts with the installment sales rules, a taxpayer can use its interest in a qualified opportunity zone as collateral for a loan without triggering the deferred gain. In other words, there is some opportunity to monetize the qualified opportunity zone investment without triggering the deferred gain, which is a very, very generous opportunity that the IRS has given us, and as I mentioned, contrasts dramatically with the opposite rule that applies with respect to installment obligations.
I think we skipped.
Sorry.
Yeah. Now moving to the inclusion of the income when the deferral ends. At the end of the deferral period, the taxpayer must include in income the excess of the lesser of the eligible gain that was rolled over, or the fair market value of the investment made in the fund as of the end of the deferral period, over the taxpayer's basis for the fund investment. The gain to be included has the same attributes in the taxable year of inclusion that it would have had if the gain had not been deferred. These attributes include, for example, those taken into account by Sections 180, 1222, 1266, and other provisions of the Code. Still on the inclusion of the income, the proposed regulations address situations in which the taxpayer holds fungible interest in the fund, for example, equivalent shares of stock of partnership's interest with identical rights that were acquired in different days. If, on a single day, the taxpayer disposed of less than all of these interests, the first-in, first-out method must be used to identify which interests were disposed of. The first-in, first-out method determines, for example, whether the gain deferral election is applicable to an investment or not. In case the gain is subject to a deferral election, the attributes of this gain at the time it is included in income, and the extent of an increase, if any, in the basis of an investment interest that is disposed of. Finally, if the first-in, first-out method does not provide an answer, like in situations where gains with different attributes are invested in identical interest at the same time, the proposed regulations provide the use of a pro rata method in order to determine the attributes of the gain to be recognized.
So, okay, on to self-certification. You may think that that given the highly technical rules and the very large tax benefit, that to be a qualified opportunity fund, you'd have to get a ruling from the IRS, and it would be a very complicated, possibly time-consuming process. But that is not the case. There is no ruling requirement. Rather, a qualified opportunity fund self-certifies. So the IRS has published a draft of the form. They've labeled it Form 8996, and on the form, the fund would self-certify that it qualified, do the calculations on the various tests, and file that form with its regular tax returns. So it is a much more streamlined process than it could have been, and really should not be onerous at all.
Our last point to mention here is that the state income tax effects, and they generally appear to be very, very beneficial, certainly in those states that follow the federal rule. Since gain is deferred under the new rules, and it's not taken as a deduction or carved out, states that are federal conformity states should offer, by default, recognize the benefits. In other words, if you're a New York taxpayer and you have entered into a qualified opportunity zone fund investment in Ohio or New Jersey or any other state for that matter, the New York should honor the deferral of the gain for New York State purposes, even though the money wasn't invested in New York State, because New York State, like many other states, follows the federal. We begin with federal taxable income, and no state yet has enacted an add back with respect to amounts deferred under qualified opportunity zone investment rules. Therefore, not only does this benefit appear to be available for federal purposes, in a great many states, it's going to be available for state taxes as well. This concludes our webinar on the IRS rules issue initial guidance on qualified opportunity zones. Thank you for joining us today. We hope the information that we shared was useful, and thank you very much for your participation, and have a great day.